So good afternoon, everyone. Welcome to the next edition of Market Matters, and appreciate your patience as we had to move this particular Market Matters section or segment from last Tuesday to this Tuesday. And the reason we did that, of course, was so that we could capture any election results that had occurred between, actually after last Tuesday. And I guess coincidentally, we still don't have an official result, but we're pretty close to one. We'll touch on that here in a moment. Just some housekeeping items before we get started. If you have any questions, we do encourage you to send those through the chat feature. I see a few of you have already sent those through already, so that's great. I'll try to address those over the course of the presentation today. As far as an agenda today, I do think it's important to revisit what's going on with COVID-19. We still are in the midst of a pandemic, lest we forget, even though it's, seems so far away since we started this whole process. We still are in the midst of that, and there are some ramifications for that longer term. We also have some economic and investment updates that we'd like to touch on. And then really addressing some of the questions that you, our clients, have had. Would there be anything different being done in our portfolio now that we do have an election outcome seemingly at hand here? So we'll touch on all of those items throughout the course of this presentation. We don't have a guest speaker today, so we'll take us right at about that 30-minute mark, and then I'll use the last few minutes for Q&A if there is any. So with that, let's kick it off. Turning to the COVID-19 updates. I think this is a great chart to show because maybe some of the recent price activity within the markets over the last couple of days would be speaking to some of the developments going on here in the pipeline. And as you can see, this is just from the New York Times vaccine tracker showing the development of the various vaccines that are coming through the pipeline and at what stage they are. Recall that phase 3 is the last stage at which there needs to be a clinical trial. And then there's limited use approval, which you may recall President Trump was able to use for his recent COVID infection. And then, of course, approved for full use throughout basically the whole population. We still have nothing on that front. But the good news is that as time goes on, as we were all hoping and as the market is expecting, phase 3, which is, again, the last stage, has now 11 drugs in phase 3 trial, which is really good because it means we've got a lot of shots on goal here. And that's 2 more than the last time we revisited this chart, which was early in October. And then the limited use, this is another good dynamic because we've got now 6 approved for limited use. And again, that could be things for very specific considerations, but where, I think this is exactly what the market has tended to be trading on. And if you recall yesterday, the market had a really nice move up, really as a result of nothing more than Pfizer announcing really positive trial results for their vaccine that they have in phase 3 trials. Now, as many doctors have suggested, anything above 70% efficacy is a really good vaccine. Pfizer indicated that their vaccine was roughly 90% effective or 90% efficacy. So, if we get through the full trial here with, no deaths and no aberrations, then this looks like a really good contender for something that would likely bring an end to the current situation that we're in. And I think, the likelihood of multiple vaccines could increase the timeline to return to normal. So that's good. We're not putting all our eggs in one basket here. And I think that's certainly the approach that the current administration is taking and likely future administrations and health officials. So I did want to mention though, this is coming in at a time when we probably need it more than ever, because as you can see on the screen in front of you, this comes from a great Bloomberg site page that you should recognize by now for those of you that have been Market Matters watchers. Really what it's showing you is global case progression here on the top, and then select country case progression on the bottom. And I think this is really important to take a note of because just a few months ago, it looked like many parts of the globe had this infection under control, particularly out of Europe, where they were, touting success with various methods of trying to tamp down the virus itself. But you can see what's happened here, particularly in Germany and the United Kingdom here on the right. We've had a really nasty explosion of virus cases in those areas. Again, a lot of it has to do with some, better testing. I will not dispute that for sure. But it also just recognizes that, this virus is not going to go away very easily. And particularly as the weather gets colder, this is a kind of a nefarious part of the virus progression, is that it's going to force people indoors as colder weather comes upon us. And that's going to, put people in closer contact with each other potentially, and could lead to, additional issues down the road. So, while some parts of the area are showing infection rates above prior peaks, we still, I think, have some areas that are now declining, which is like in India, that's a good example. Brazil, another good example, emerging markets, because they would ostensibly be better able to handle these. And I think that's a good dynamic in the emerging markets. But certainly something we want to watch out for, because again, the longer this virus goes on, the more of a toll this takes on the economies that are struggling to deal with it, and therefore, makes it more challenging to invest around, because then the outcomes become much more disparate than they would be maybe today. So let's take a look at some economic and investment updates. We have changed a couple of ratings, although these are just very minor changes. And you recall, these are from last period. So the last period, we had this in October. You can see where the previous rating was for each of these categories, if they're indicated, and where we are now. And really all we're reflecting here is a slight downgrade to developed markets on the international side, meaning that we don't find developed markets as attractive as they once were. Primarily that has to do with their slow growth dynamics, but also their, particularly out of Europe, their inability to, deal with the virus in a way that's bringing some containment to it. So I think, this virus actually cuts a little bit deeper in places that have slower growth, because there's less of a buffer to fall back on. Interestingly, and I'll touch on this a little bit more, we are upgrading government bonds to a neutral weight, and that has almost everything to do with the fact that rates in government bonds on the 10-year now have risen a little bit since the last time we spoke. And this is a recent upgrade. I mean, now the 10-year bond yield is right around 95 or 96 basis points. Recall back in April, we were at 30 or 40 basis points, so 0.30. And we think that 1% rate is actually a pretty good cushion now to be able to get comfort that if the markets do sell off, that we will have adequate protection within our bond portfolio. And those are just the real, I would say, more recent changes. And here's just some portfolio notes. We still continue to accumulate what we call dry powder through an ultra short ETF, a bond ETF, basically building up a little bit of a cash reserve in advance of likely very volatile market conditions on the equity side going forward. And again, I think that what the market's activity is suggesting would be that we get a vaccine approval in late 2020 or early 2021. And the reason that's important from an expectation standpoint is to say that if it doesn't happen in early 21, then the markets may be in for a bit of a wild ride to the downside for a brief period. And just generally speaking, what are we looking to do now? Well, we started this process already, but we are looking for opportunities to do additional tax loss harvesting this year if there are any. Some bond positions we've started working on the mutual fund side, some individual stock positions, so you might notice some activity going on. This is just one of the value adds that we can use within the account, particularly if capital gains rates go up anytime in the near future. On the equity side, I would note here, when you'll see it in just a moment, but earnings are surprising to the upside pretty nicely, particularly in the S&P, but also some other areas in the globe. And that's also, I think, really supportive for markets, because we are on the high side of valuations. So had earnings not surprised to the upside to the degree they had, that we may have been in for a little bit of a pullback potentially. Interestingly, the dollar has stopped falling. Recall that over the course of from April to October, the dollar was falling versus our trading partners, and that was our catalyst for upgrading international stocks. But what I think has been a good dynamic is that for those portfolios where we have added emerging markets, emerging market positions, in a small amount, of course, have continued to rally despite the fact that they're facing a currency headwind. So that's a really, I think, good dynamic for emerging markets within those select strategies. We still have a rebalance target on the upside of 3,600 on the S&P. and 2650 on the downside for the S&P. So if we get to those levels, just be aware that we'll start our rebalancing process. And as you may have noted so far this year already, that rebalancing process has added substantial amounts of return to client accounts because we've been able to rebalance at very opportunistic times, like in March and mid-July. For fixed income, I think the story remains the same as you'll see here in a moment, but yields in the bond market right now are continuing to anticipate more QE, and that would likely leave us with a range-bound opportunity set within fixed income. And just for a longer-term perspective, we still expect rate yields to remain pretty low for the foreseeable future, with higher yields later as growth picks up down the road. And then finally, we're looking to alternatives for a couple of different reasons, but primarily looking to our alternative section for income generation, because yields you can find in some alternative strategies are far higher than you can find in the government bond and agency bond and even corporate bond world in some cases. So we think that's going to be an increasingly important part of our portfolios to generate yield out of, either on the private side or on the public mutual fund side. So let's take a look at some of the economic data, which I think is really useful to just observe. Because what you're seeing here on the screen is a picture of manufacturing activity in the US starting in the year 2000 and ending here with the most recent data point that came out last month. Just for reference, any number below 50 would mean that the economy or the manufacturing sector is in contraction, meaning that's shrinking. And what you see here, or what you can observe on the screen, is that while we did have a few months of contraction, call it March, April, May, June probably, July, August, September, October have just been rip-roaring, and even getting us to a faster recovery rate than even was back in 2000, of course, which I think is really an interesting corollary, but also maybe even in the 2008, 9, and 10 timeframe. So a really rapid recovery back in the manufacturing sector. Even though it may not feel like it, that sector is continuing to power forward, which is just great to see. So that's a very supportive underpinning. Let's take a look at the services side, because the services side, of course, is where a majority of our economy now is allocated. It's roughly 70% services, 30% manufacturing, or thereabouts. And you can see similar data series. This is the ISM Services Index. Anything below 50 means we're in contraction. Anything above 50 means we're in expansion. And what you can see is the last, call it 6 months, we've been well into contraction, even above those levels of 2010, I would add, and 2011, kind of right at those levels where we had a really rapid recovery and snapback from a steep decline that we had earlier in the year. So both the manufacturing side and the services side of the economies are doing quite well, which is good to see for sure. Remember, though, that doesn't necessarily translate into individual benefit or not. Are people making more money on average? No, they're not, because there's more unemployment. But what it does mean is that companies are becoming more efficient. And recall, we do have a forecast for 21, and I think it's pretty much in line with what most of the other sell-side research firms would be projecting, and that is the consensus forecasts. If you were to aggregate all 49 forecasts from all, the Bank of New York's, Goldman Sachs, Morgan Stanley, the consensus is to get roughly 4% growth in next year in 2021. And just by way of reference, we haven't seen 4% growth rate in the US since 2009. And that was only for very briefly. So we're coming off a very visceral negative year for sure. But remember, markets really react to rates of change that are either positive or negative. And we've got a really strong updraft in growth set for 2021. Part of that has to do with the fact as well that we're anticipating a pretty large stimulus package coming through from the Biden administration. It's likely not going to be what he wants from a size perspective. I think he was looking for a $2 trillion stimulus package. With the Republicans still in control of the Senate, that's likely to be tamped down, but I think everyone would agree that once the expiration of the current one occurred, that we were on the clock for another one, because the drawdown in economic activity has just been hitting people individually so pretty hard. But this is a good backdrop, I guess is my point here. 4% in 21 is a really good backdrop to invest against. And I just threw this chart in here because I thought it was really interesting. Despite what you may have heard about, 150,000 restaurants going out of business in New York, I think that it certainly is the case in New York City. Would you be surprised to know that the restaurant index that comprises public restaurant index, public companies that are restaurants, is now at an all-time high? I mean, who would have thought that, 6 months ago? But I think it just goes to show you that, things are changing very rapidly, and it's important to be flexible in one's thinking, which is also, I think, one reason why we've had a pretty good experience this year across our strategies, is because we had a pretty flexible mindset coming into and out of the earlier parts of the pandemic. So let's take a look at the market data. And this is the equity markets in front of you. This should look pretty familiar because I want to make sure that we are consistent with our outputs here. S&P large cap US stocks here in the red line, emerging market stocks are in the pink line, developed international stocks, that would be things like Japanese or European stocks in the green line, and then small companies down here in the blue line. And the only observation I would make is that we still have a sizable overweight to US companies relative to other benchmarks or peers. And just by way of reference, in some of our benchmark strategies, we only have a small 30% weighting to international stocks on average in some of those strategies. But look at what's happened to emerging markets. They have caught up quite a bit since the days of midsummer. And a lot of that has to do with the fact that their valuations were extremely cheap coming into late summer. And now they're kind of rising all in unison here to approach US stock price performance. A lot of that, interestingly, is coming from China. The Chinese tech sector is actually, believe it or not, done better on average than the NASDAQ 100 this year because they have big names in China like Tencent or Alibaba, Baidu, that are really dominant in their sectors and industries in Asia. And that's really powering that index forward. So really interesting to see how that's kind of evolving. But again, I think that this chart right here would also tell you why we don't like or have downgraded international developed stocks. And that is because they really haven't done a whole lot for the better part of 5 or 6 months, despite having, some better earnings reports out of some sectors. And I think it just shows you that the growth outlook for that region is still very weak, borderline, negative, if you will. And this is the earnings picture I was referring to. This is a view of Q3 earnings in the S&P 500 that I've shown this chart once or twice before, but I do think it's important to revisit just to show you some of the evidence that's leading us to some of these opinions. So what this shows you is that, sorry, let me let some more people into the webcast here. It shows you Q3 earnings on a year-over-year basis. So from Q3 last year to Q3 this year. What's been the experience in these companies. And you can see the habitual offenders, energy, industrials, consumer discretionary, have all had negative earnings year over year, which makes sense, I think. The good news is that even those sectors are beating the estimates. So this line basically means in September 30th, what did analysts expect to happen versus what actually did the companies report? And the good news is that the sectors that we have the most exposure to are the ones I have here outlined particularly in our dividend strategy or dividend hybrid strategy. And all of these sectors are substantially outperforming the expectation, which I think is where you're seeing a lot of the upside lift coming from in some of those areas. So I guess, healthcare in particular, that's one of our favorite sectors because it's still very reasonably valued, massive demographic tailwind that is helping propel some of those sectors higher. And it's likely that's even going to become more important, particularly in a year like we have this year, where a pandemic is on everybody's lips. But I think one of the takeaways I would have from this chart is that stock or sector selection is becoming increasingly more important, and one of the few ways in the future that one will be able to achieve outperformance or just really substantially positive performance, given where valuations are. But this is a really good news scenario here. I just wanted to point that out. Turning to fixed income briefly, it's been a tale of, rapid recovery because recall the Fed stepped in with very supportive bond purchase programs, particularly on the municipal bond side and the corporate bond side. But really since early summer, June or July, not a lot has happened. I mean, you can see here, it's been pretty much a flat performance dynamic across the aggregate bond index, which is mainly government bonds. And even to that point, to some degree, the corporate bond index, because, rates can only go so low, spreads can only get so tight. And, at some point, the juice is not worth the squeeze, if you will. Some other sectors that we do find interesting right now are emerging market bonds. We haven't allocated to those. It's on our watch list to take a look at, particularly dollar denominated, because those yields, the starting yields on emerging market bonds, are far higher than US or any developed market for that matter. Starting yields are roughly 4 to 5% versus negative to 1 in most developed markets. So we've got our eye on that. Now let's turn to some post-election considerations here, which I think are, again, top of mind for a lot of folks, and I certainly can appreciate that. And what are some investment implications? Well, as you may recall, I think, as we mentioned prior to the election, the best outcome, the outcome we could all be hoping for as investors would be, and this is, of course, to leave, your personal feelings aside for a moment, but as an investor, what you really want is a divided government. And the reason that is because in a divided government, there's a requirement to compromise. And by divided government, I mean one party has has the Senate or the House, and the other party has the presidency, or vice versa. And what that does is it slows down decision making. It also prevents very large changes from happening very easily. So I think part of what happened last week, so remember last week we had a really nice rally in the S&P. It was up around 7.5% or so, which was, and would make it, believe it or not, the largest rally in a week, in an election week since 1930. The reason that we had such a big rally was because it looks like the likelihood of President-elect Biden changing the tax rate substantially is going to be very low, because the Republicans just wouldn't let that happen. Without any sort of concessions or compromise. And you can see here the situation that we're in currently. So I just highlighted going back to 1928 through 2017. Not sure why the data series. Oh, well, I guess it's because the President Trump's term hasn't officially ended yet. But you can see here what the experience has been when you've got the Democratic president, split Congress, and the number of years that's occurred. That's really fascinating, that it's only been 4 years since 1928 that this dynamic has occurred. You can see what we're coming from is a Republican president with a split Congress. And I guess the good news is that history is on our side, in that with a divided government, 16% return has been the average. So that's nothing really to sneeze at, and that would be above market returns for sure over the long term. So I guess the implications for right now are we don't feel a need to make any dramatic changes, because not a lot is going to change from a tax perspective, at least initially, or any other perspective for that matter. Let's see here. And moving to, and this was just an interesting chart I thought I'd share. Charles Schwab, I found this from Charles Schwab yesterday. But what it shows you is the performance of the equity market, the all country world, and this is the global stock market index, percentage change in the global stock market index from election day to inauguration day, because there is kind of this, dead period, if you will, where outgoing presidents in general, not just President Trump, but outgoing presidents in general, really haven't wanted to do anything, because they would theoretically get no credit for it, and there's not really a big incentive to do much other than just kind of ride off into the sunset, if you will. And you can see the experience of the last seven presidencies, or six now, 7. And I guess reason I'm showing this chart is to suggest that we've actually surprised to the upside, at least on average here, with President Biden's election. And so our base case here would be that we just get a sideways market until inauguration day. So, I just wanted to point that out. So here are just some key takeaways. I think not a lot of these are substantially different from what we've been messaging in the past, but I think that's good news, because if they would be, then then maybe that would suggest a paradigm shift of some sort. But it doesn't look like we're coming into any paradigm shifts, which is good news. So I guess from the stock side or the equity side, stock markets, in our estimation, still are going to be where we find positive return, albeit probably lower than we experienced over the last 10 years, just from a valuation perspective. But along with that positive return is certainly going to come more volatility. And we have started to see some of that upside volatility over the last week, downside volatility over the summer, and also in February and March. And I think that's just going to be the price we have to pay for equity exposure going forward. Because that's, if you can't earn, a substantial return in the fixed income side, as we likely would have been able to do, 10 years ago, then there's going to be an outlet or release valve for that particular dynamic. I would also mention here that some takeaways: having a programmatic rebalancing process has added an exceptional amount of value this year. Obviously, I can't describe exactly what that is because it's going to vary by account, because more accounts that have more equity exposure benefited from having obviously an upside market, but also rebalancing more so than those that had more fixed income exposure. But I would estimate if you were in a 60-40 portfolio, just having this programmatic policy in place has added around 1% to return this year, which is great, because typically it's around 50 to 75 basis points. And what's creating these opportunities? Well, it's volatility between asset categories. So we haven't seen a lot of volatility from the bond market yet. That is something to watch out for. But really, where have we seen most of the volatility? It's been in things like the stock market for sure, but also in some other more esoteric asset categories, like things like Bitcoin or some of the private equity markets, things of that nature. And I guess the takeaway is that we need to be ready to act when the time comes. And we're doing that with building up our cash reserve again. And so we are expecting, again, lower yields for now, because I quite frankly, the budget in the US can't afford higher yields for a very long period of time. Interest expense at the federal government level alone right now is roughly 20% of our budget. If yields were to go on average from where they were a week ago, 75 basis points to 150, of course, that would mean that we would be doubling the interest expense line item on the budget as bonds would roll off. And that would be a very bad situation to be in, because now we'd be at a 40% interest expense versus 20. And the Fed and the federal government just can't afford that. But inflation does remain nascent, which is good news for equity investors, because inflation is the real boogeyman for stocks. And if that decided to show up again, that would mean that we should expect some, flattish type returns going forward. And that is a key catalyst for value, a value rotation, by the way. So, a lot of people are asking, what's going to be the reason or the impetus for, growth companies or growth stocks to sell off and rotate back into value companies, which would be more like the banks, industrials, energy. And I think it's when inflation starts to show up, driven by above trend growth, which we may be getting next year, that would be a key reason to rotate to more value orientation. So with that, I'm going to take some questions. We've got one here. It says, what's the plan when the dollar loses 30% in value? What are some upcoming dangers of this law? And I think, the plan is, we certainly will be watching this. And I think there are many other, market participants looking for this type of dynamic to occur. But for right now, if the dollar is actually appreciating recently versus depreciating. So I think that certainly goes a long way to suggesting that we've got some time before we have to worry about that dynamic. However, if the dollar were to lose 30% of value, I think that would be a key reason to start allocating more heavily to international stocks for sure. And even potentially things like gold or other hard assets that are denominated in value that can maintain price stability. Another question here, so thank you for that question. Another question here would be, how does Schwab buying TD affect any future paperwork we might receive, and when do you expect that to start? So as far as affecting, from a paperwork standpoint, there should be a TD account right now. There should be no additional paperwork you need to merge that account into Schwab. That's going to be going on in the background. So at some point, Schwab will bring those TD accounts over under their umbrella. So as far as we know right now, there's going to be no additional paperwork, which is good news because they want it to be a good client experience as well. Another question here is, when do we rebalance? That's a great question. Thank you. It's the when question really depends on volatility, realized volatility, or realized, appreciation or depreciation, primarily coming out of the stock portfolio. So that drives everything because, by design, stocks are much more volatile than bonds. I guess there would be a situation where, bonds could be more volatile than stocks. I don't know if we all want to live in that world, but it would be a pretty ugly day when bonds are more volatile than stocks. But volatility within the stock market is really what's driving that. And typically, just to give you an idea, what we're targeting is a 1 to 1.5 average move up or down in the stock market to trigger our rebalance process. And that's served us pretty well. We've had this particular rebalance process in place for the better part of about 8 years now. And it's done a great job of not rebalancing too much, but also rebalancing at times when it's really been additive. And I would just point you to the last 2 years where that's really worked out in spades. Let's see here. With regard to Schwab, what will be Gratus' status approving the merger institutional custodian? Yeah, so we're still planning on maintaining all of our positions or accounts that we have currently at Schwab. So there's no reason to worry about moving anywhere or anything happening as a result of the merger. So, but thank you for that question. We still feel like we'll have a good partner in Schwab. I mean, it does, of course, bring up some, questions in our mind sometimes around having competitors, because you want to make sure you're holding your competitor, in good faith. But I think they've done everything that they need to do to prove that to us. They're going to be a great partner. Another question here would be, should the Supreme Court throw out Obamacare in its entirety? What do you see the impact on healthcare stocks? So, well, that's going to be an interesting question to grapple with, because I think certainly with President-elect Biden coming in, he's going to do everything he can to support Obamacare. But I don't necessarily think the scope will be able to expand too greatly by executive order. I mean, that's really going to be the position that he's in right now, is that his hands really will be tied, because those are legislative affairs, not necessarily executive order affairs. So his hands will be tied. As far as relating to healthcare stocks, we still think that there could be some impact, particularly if Obamacare is expanded to the pharmaceutical industry, because I know there's been quite a bit of talk around price controls, and not price controls, but more, reining in drug costs in various ways. So there may be some downward impact on that, but I would suggest that some of those stocks have already reflected that in lead up to the election performance. I mean, you just look at the majority of the sector, and it's been a flat to slightly negative year for the whole sector. Some, of course, better than others, but that really has been baking in some of that eventual outcome. But remember, those companies are cash machines, and they're going to be able to, I think, develop new therapeutics or technologies or healthcare solutions that are addressing real needs. And, in those cases, the FDA has been very friendly to pharmaceutical companies, because they are solving acute health needs. And who could stand in the way of, solving multiple myeloma or something like that? I mean, that would just be unheard of. So anyway, thanks for that question. I think it's a very low likelihood right now, but certainly there's multiple dynamics at work there, and our exposure tends to be, just by way of reference, our exposure to healthcare tends to be actually in the medical device companies, not necessarily in pharmaceuticals, although we do have a couple of positions there, and certainly not in the health insurers. The health insurers are really the ones that have the target painted on their back in the case that Obamacare gets enhanced to any sort of degree. And then the final question here is, will there be another update on the private market funds, the GCO funds? Thanks for that question. Yeah, so we're going to be doing going into a 6-month interval for those. So the next update you could expect from Patrick and myself on the private market funds would be, well, he sends out quarterly updates, written updates to all investors that are currently in our private market funds. As far as the webinars go, we're targeting a 6-month window for live updates on those. So we'll definitely be providing you with maybe a more granular schedule on what to expect and when, but that should be coming sometime early next year. So I think that hopefully answers your question there. Thanks for asking that. So I'll just leave it open here for an additional time or questions that you all might have, because that takes us a little bit past 2:35, but I think it's been time well spent. So let's see here. I'll give it just a minute or two more. I think I check the question queue here real quick. Yeah, I think I got all of those. Well, good. So I definitely want to thank you for spending some time with us this afternoon. We really enjoy putting these on and hearing some of the questions that are on your mind. If anything comes up, please feel free to give either myself or your wealth advisor an email or call. I do hope, actually, not to be overlooked, I hope you guys like the new logo. It's up there in the upper right-hand corner. And we spent a lot of time and agony on that. Particularly, big shout out to our marketing director, Tyler, who put that together. We think it's a great symbol of the new Gratus, if you will. So hope you enjoy that. So we'll talk to you next month. Thank you.